Commodities can play an important role within a diversified portfolio. Historically, they've tended to do well during inflationary times, an economic environment in which both equities and bonds have tended to suffer. But this trait is not unique, and in this video, I will show you how trend following can not only play a similar inflation hedging role within a diversified portfolio, but be the better choice overall. How's it, everyone? My name is Bruno. I'm a co-founder of Ironclad Asset Management, and for some time now, we've shared our views on how investors can better diversify their portfolios by considering alternative strategies as opposed to just asset classes to enhance their expected returns. A great example of this has been trend following, and we believe that it's the single most compelling diversifier to an equity and bond portfolio available. We've covered why we think so in a separate video that you can find by following the link in the description box below. One common question we've received has been whether we think that trend following can play a similar role as commodities within a portfolio. In short, we think trend following is superior for three key reasons. First, we think it offers significantly higher expected returns over time. Second, while still offering the potential to do well in inflationary times. And third, it offers far superior diversification benefits for the portfolio as a whole, which in short means a higher expected return. Let's have a look at the empirical evidence that led us to these conclusions. For starters, a quick definition. Trend following is an investment strategy which purchases rising markets and sells falling markets with the aim of profiting from a continuation of those trends. Trend following invests in some of the largest equity, fixed income, currency, and commodity markets in the world, and so commodities are central to the strategy. But the difference comes in that you don't simply buy and hold the commodities passively, but rather are only long the commodities after prices have been rising and are short commodities after prices have been falling, meaning that one can profit from both up and down markets. If we look at the last 23 years of performance history, the difference is plain for all to see. Here we plot the All-Country World Index in black to represent global equities, the SG Trend Index in red to represent trend following, and the S&P GSCI Index in blue to represent a broad basket of commodities. Trend following has delivered really attractive equity-like returns over time. But in contrast, commodities had a good run up to the 2008 global financial crisis, but then suffered a drawdown it is yet to recover from, effectively going sideways over this period with significant volatility. At this stage, a good counter-argument would be that investors can still make use of a seemingly disappointing strategy in standalone terms, provided that it offers good diversification benefits for the portfolio as a whole. The reason for this is simply down to better diversification. Reducing variance drag within a portfolio makes for better compounding over time. So, to assess the portfolio level contributions that each could potentially bring, let's isolate for the times in which equity needed help the most. It is true that commodities delivered positive and attractive returns during the inflationary 2022 equity drawdown. However, so did trend following, delivering 36% for the year through October 2022. And when we zoom into the three other major equity drawdowns over this period, we see that commodities only really helped during the dot-com bubble burst in the early 2000s, going down with equities during the COVID crash and during the 2008 global financial crisis. In contrast, trend following meaningfully offset losses during the early 2000s dot-com bubble burst episode, as well as the 2008 global financial crisis. It was, however, flat during the COVID crash, but at least didn't contribute to portfolio losses. When we zoom into the risk profiles, we see that commodities were almost twice as volatile as trend following over this period. Trend following's deepest drawdowns appeared modest as compared to commodities. It is well established that trend followers explicitly control for risk, partly using a technique called volatility targeting. They tend to reduce exposure when volatility flares up, and so it shouldn't be much of a surprise to see that trend following drawdowns often breach 10%, but only occasionally breach 20%, with the deepest drawdown on record being minus 23%. This was significantly lower than that of both equities and commodities. When we categorize monthly historical returns by different economic regimes, specifically rising and falling inflation and rising and falling growth, we clearly see the use case for commodities. It's done well during inflationary times, as can be seen by the graph. But so has trend following. And in addition, it was also meaningfully positive during all other economic environments. where commodities were only really positive during rising inflation and rising growth environments. To better understand the relationship between commodities and trend following, we use a scatter plot of monthly returns. Each dot on the graph represents the return of commodities on the x-axis and the matching period return of trend following on the y-axis. What we find is that, on average, when commodity returns have been positive, trend following returns have also been positive. In fact, the stronger the returns on commodities have been, the stronger the returns of trend following have tended to be as well. We call this characteristic convexity. And what we find is that when commodity returns have been significantly negative, trend following returns have actually been significantly positive. And the stronger the negative returns on commodities have been, the stronger the returns on trend following have been as well. So this convexity appears not only on the right tail of the commodity return distribution, but on the left tail as well. Let's extend this view to how both commodities in blue and trend following in red have behaved relative to equity returns that we now plot on the x-axis. What we see is that trend following retains this highly attractive positive convexity, this U-shaped payoff profile, where during the very best times and during the very worst times, trend following returns have tended to be positive on average. And the same simply cannot be said for commodities, which have historically suffered in tandem with equities during the very bad times and have only been mildly positive with equity during the good times. And when we look at how correlated the pair have been with respect to equity over a 12-month look-back period, we find that trend following in red has often been negatively correlated, which is a highly attractive trait for diversification purposes. Once more, the same cannot be said for commodities. Finally, let's put this all together by having a look at the impact that both a commodity overlay and a trend following overlay can have on a balanced 60% equity, 40% bond portfolio mix. Specifically, we overlay a 20% commodity allocation on top of a balanced portfolio in blue and a 40% trend following allocation on top of a balanced portfolio in red. So why the difference in allocation? Well, this is roughly an apples to apples comparison because commodities have roughly been about twice as volatile as trend following historically. So a typical balanced portfolio in black with a commodities overlay in blue and with a trend following overlay in red. We see that the overlay portfolios did better than the balanced portfolio right up to the global financial crisis. But where trend following meaningfully offset equity losses during the crisis, commodities did not. The trend following portfolio thus opened a gap, and that gap has become bigger ever since, especially thanks to significantly better crisis time performance. In short, the trend following overlay portfolio delivered the most attractive risk profile, the highest return, as well as the most attractive Sharpe ratio over this period, making it the clear choice for inclusion within a balanced portfolio. In addition, despite trend following having what is known as a lost decade during the 2010s, a decade in which it effectively went sideways in isolation, we don't really see this hurting the portfolio when trend following is applied as an overlay. The overlay portfolio kept up on a relative basis with conventional balanced portfolios, despite trend following not contributing in isolation. This is a really important finding for investors who are hesitant to sell out of existing equity or bond exposure in order to make an allocation to trend following. You don't have to. You can overlay trend following exposure on top of existing equity or bond exposure. So, in conclusion, we are often asked about whether trend following can play a similar role as commodities within a diversified portfolio. We can confidently say that they are similar in that they both offer a reasonable expectation of performing well during inflationary times, but very different in that trend following offers a significantly more attractive standalone expected return over time, with meaningfully more portfolio diversification benefits. If you made it this far into the video, I'd like to thank you for your time. We'd be very interested in hearing your feedback or answering any questions that you might have about this strategy or any other. I'd like to invite you to follow the link to our website in the description box below. Thank you, and I'll see you in the next one.